Business Report. I'm Tony St. James, joined by Bob Maurer. Bob's with Manduca Trading in Chicago. We'll give you contact information for Bob in just a few moments. You know, the thing, Bob, that really kind of jumps out at me today when you look at the markets. On Monday, the close for soybeans, 20 cents or lower on quite a few contracts, almost a dime lower on the new crop corn contracts. There seems to be a bit of bullish news out there, but the market's not reacting that way.
Well, it's not reacting that way quite yet. You're right. So it's kind of interesting when the market does have some bullish fundamentals behind it, or at least some kind of bullish teeth, and then the market does trade counterintuitive to the readily available information out there. So it's something you got to keep an eye on, but nonetheless, I think that over the long term, markets tend to gravitate towards the price direction when it comes to those fundamental reasons for a market to push one way or the other. And I think in soybeans at this point, it's still probably for a little bit of a, I should say, supportive feature in the marketplace. But we're going to see these cycles. We're going to see these moves. And I guess the most important thing is if the market does start to take off, counterintuitively, what you would think would happen out there relative to some of the bigger fundamental things pushing the market around, that's why you got to have your marketing plans in place, because I guess the market could stay irrational for longer than we can kind of defend that irrationality at times, if you follow my gist there. But soybeans, like you said, off today, down 28.75 for the November futures, kind of pushing back down towards the technical level, which had been support over the last couple of swings that we've seen to the downside, which to me is the 200-day moving average, which really comes in right about where we settled today. So it's going to be interesting to see how she trades tomorrow, or over the next couple of days, I should say, and whether or not the soybeans are going to be able to hold the recent swing lows of about 12.62. And the pressure comes in on a couple of things. One is, obviously, we would expect by the rather open window of weather over the weekend that some good progress was made when it comes to harvest. So I think that was part of it. And then also there's this backdrop of expectations for soybean yields to exceed the USDA's September forecast. So as the harvest has occurred and anecdotal evidence comes out, and really we're in a Twitter world. I don't mean to plug Twitter and for in specific with their IPO coming out or anything like that, but nonetheless, we're in a Twitter world. So a lot of these producers out there, they're out there, on the combine and basically plugging away and sending out data of what they're experiencing when it comes to the yields they're getting. And this information is coming in fast and furious. And so far, it seems that on balance, those expected yields are tweaking themselves higher and probably are going to exceed the USDA September forecast. Now, on the flip side of that, and what we were talking about earlier, and I think alluding to what you had mentioned, is that we do have the harvest winding down. I think the expectations for this afternoon's report, now that the USDA is back online, should be about harvest progress about 82%. I think 75 to 82-ish would be a fair guess for the progress in the report this afternoon. So we are getting towards the tail end of harvest. So hopefully, if we do see it withstand this pressure right now with corn falling and soybeans falling, that we maybe are getting towards the worst of it when it comes to the harvest pressure. We also have demand factors that are pretty darn strong still. We've got more demand for U.S. soybeans internationally, and also very favorable crush margins. Commercial traders are in there, bidding for newly harvested bushels for both crush and the export channel. So those elements are there trying to counteract some of this harvest pressure and some of the uptick that we've seen in yields. So we've seen a sideways action in prices. If you look at the last month or so, we've basically been trading from about, 13, 15-ish a bushel in the nove beans to, like I mentioned, the recent high 1260s, and we are down towards the low end of that range. So we'll see if we can withstand this push to the downside. But, these cycles up and down are going to be expected, especially, with, the big picture that we see here. Now, that's for soybeans. Also, the other row crop that we have, corn futures today, pushing 9 1/4 lower. These contract ending only just a half cent off the day's low, down at 4.33. This market, I believe, made a new swing low today, and bullish markets don't necessarily make new lows. So, interesting dynamic there for corn. It's always been the yield picture and how things have been so abysmal, a few months ago, and then obviously we started getting the evidence that yields were a little better than expected. line and they start issuing some of the reports that they weren't able to do during the dark period there. They came out with the Commitment of Traders report through October 1st and showed that the commercial traders were net short another almost 18,000 contracts for the week, and that's some short-term pressure going on in the marketplace from some of the bigger players there. On the flip side of that, the non-commercial, non-reportable traders built a net short position with almost 229,000 contracts, which is up almost 23,000 contracts for that week. And that, for those categories, represents a new record short. And when you start talking about new record shorts in some of the speculative sectors of that commitment of traders, that tends to be bullish. So we're going to watch that. We're going to see if this market gets one more push to the downside as we get towards through the bulk of harvest or so, and hopefully builds a bottom, and then you're going to start shaking some of these new shorts out. As for the harvest progress, I think the expectations for this afternoon's report is somewhere around the 50 to 55% done level. So we'll see what the USDA comes out with in a short period and trade against that. And then obviously wheat, big player kind of following the markets right now, the row crops that is, and soybeans or wheat in the Chicago market down about a dime, Minneapolis down about 9 cents, Kansas City down about 8 cents or so. There, too, we've got a kind of a messy picture when it comes to the fundamentals. The markets rallied quite a bit in the Chicago market, rallied quite a bit in the winter wheat markets, and now we're just trying to see if we can sustain those gains. Internationally speaking, we've got a little pressure. We've got India, who has come out and started talking about perhaps lowering the minimum price that they'll be looking to sell some of their excess into the world market to, somewhere about, I don't know, maybe $260 per metric ton they can cut the floor to, as opposed to the 300 level right now. So we'll see if that actually occurs, and that could add some pressure to our market, make it a little bit more harder to compete internationally. And then for the upside, I think the international picture is kind of creating a little bit of a push-pull in the marketplace. You got that pressure from India, but then you also have the Argentinian market, which is still suspect, and then also the Australian market, which is still suspect on whether or not they're going to have a decent crop. So that's kind of propping it up. So we're looking at technical levels right now in the wheat markets. Hard red winter wheat in Kansas City pushing down today, like I said, by about 9 cents, but sitting right on a technical level that could hold as support. But again, it's really going to be hard for the market to hold up if corn and beans continue to fall like they did. So I think we're nearing a harvest low, just maybe haven't quite hit it yet.
Bob, let's look over at the cattle market, talking about live and feeder cattle. And we're higher on Monday. Just keep moving higher. Is that a byproduct of the lower grains?
I think it's helped by the lower grains. I don't know if it's necessarily solely due to the lower grains. I think that's an input. I think that cattle in and of itself, with the relatively tight supply situation, is kind of driven on its own fundamentals. I think we get momentarily manipulated by what's going on in the grain and the oilseed prices on those inputs. But nonetheless, I think that the overall picture for beef is pretty strong. Now, we've got those tightening supply projections for November and December that continue to come into fruition. We've got buying support from fund traders and speculators. The chart looks constructive, meaning that as the market has rallied, you've seen generally higher volume and generally higher open interest, and that's definitely constructive for trend traders in the marketplace, and I think that's why they continue to come in and buy on dips. Commitment of Traders report, as mentioned earlier, for the grains, the USDA came out and posted things through October 1st, and it showed that the non-commercial traders had increased their position by about 23,000 contracts. So to the point about a constructive chart, there you go. You see some of the non-commercial traders going in there and continuing to buy, at least through the October 1st time window there. And I believe the USDA is going to try to make up on those Commitment of Trader reports by the end of this week or next week. So it's going to be interesting to see those numbers as they come out from the USDA, although it's delayed, to see if they continue to buy, which is my suspect at this point, my suspicions at this point. Now, week to week, we got weaker packer margins. That's a little bit of a pressure point in the marketplace. And we do have reduced slaughter totals. Producers are kind of halting liquidation at this point. That's why the slaughter number came out last week at 618,000, clearly about 30,000 less or so than last year. When you look at the cattle slaughter data, feedlots are relatively current heading into the final months of 2013 with the slaughter levels that we're seeing. Beef cow slaughter, when you pull that actual number out slaughter numbers that came out were about 55,500 head, which is only about 85% of a year ago. That's a lot of numbers. So basically what we're seeing is that beef cow slaughter has been below year-ago levels since late June. And that's really because cow inventory totals in general are lower. And then also we're starting to see what feels like a build-up back in the inventory here in the U.S., which is going to take a couple of years to get through that. But nonetheless, it's the start with these lower grain prices. I think that's adding the confidence to go ahead and build the inventory. Cash this week expected to be out steady to maybe $1 better. And based on the good start so far for the futures, it seems like that might come into fruition. Basis levels are about normal. And when you look at beef prices, last week we ended up $4.70 above the previous Friday quote for the choice cutout, and $3.30 or so above the previous select cutout Friday on Friday basis, that is. So beef prices are heading in the right direction to help out the packers, and I think that's supportive for the market too. So yeah, grain prices are low, but there's plenty of solid fundamental reasons for this market to hold up as it is.
Okay, contact information. How can we talk one-on-one?
Toll-free number is 800-388-0998, and email address is bmaurer, that's B-M-A-U-R-E-R, at mandukatrading.com, and then the website, if you want to come visit us, is the same, www.mandukatrading.com.
Yep, Bob Maurer is with Manduka Trading in Chicago, joins us on today's Agribusiness Report.
Whew, hot enough for you?
Hey, life in the